You log into your bank app, look at a massive lump sum in your checking account, and you immediately feel flush with cash. But that single giant number creates a dangerous psychological illusion. It tricks your brain into feeling a false sense of security, often leading you to buy something impulsive, like a new laptop, with the exact cash you actually need to cover rent next week. Consider Emily. She had 3 separate bank accounts open, but she functionally treated them as one massive ducat. Instead of separating money by purpose, her daily cash, emergency reserves, and long-term savings poured into the exact same pool. Managing this commingled account requires exhausting mental gymnastics. Every swipe meant remembering which fraction was for groceries versus medical emergencies. Eventually, that cognitive friction fractures willpower. By the end of every month, Emily accidentally burned right through the money she was supposed to save. Accidental overspending rarely means you don't make enough money. It means your money lacks functional boundaries. To stop the leak, a mechanical system must replace willpower. Emily's father, a retired banker, sat her down to explain how the system is engineered to work. Every dollar has a specific job, and money must be strictly separated based on that job's timeline. The first job belongs to the checking or current account. Think of this as your high-speed daily operator. Checking is built purely for high-frequency liquidity, rapidly dispatching cash to cover immediate costs like rent, gas, and groceries. But there is a strict constraint. It should never hold more than 1 month of living expenses. Excess cash here is highly vulnerable to impulse spending. Excess cash meant for short-term protection moves to the second job, the savings account, acting as your shield. The mechanical advantage of savings is structural segregation. The cash remains liquid enough that you can withdraw it instantly during a crisis, but it is entirely disconnected from your debit card, preventing accidental point-of-sale spending. Following this rule, Emily carved out $5,000, moved it into a separate savings account, and established a strict prohibition against using it for anything other than true emergencies. By physically isolating her immediate operational costs from her short-term emergency funds, she removed the daily temptation to spend her safety net. The bank's architecture now handled the boundary that her memory used to manage. That leaves the capital she won't need right away, which brings us to the third job, the fixed deposit. This is the long-term vault. A fixed deposit operates on a core trade-off. The bank compensates you with a higher interest rate, and in exchange, you surrender immediate access to your capital. This account is exclusively reserved for money you won't need for at least 12 months. Emily took $10,000 of her accumulated long-term savings and locked it into a 12-month fixed deposit, mechanically protecting the funds from her own behavioral habits. The true power of the fixed deposit is the deliberate introduction of friction. By making the money highly illiquid, the account itself serves as a behavioral guardrail against impulse purchasing. Fast forward 6 months, and Emily's financial landscape looked entirely different. Her chronic overspending had completely ceased. Her $5,000 shield remained entirely untouched, sitting safely in savings and fully insulated from her daily operations. Meanwhile, her $10,000 vault was securely locked in the fixed deposit, steadily accumulating interest. Her accounts now matched her actual obligations, and she reached this point without having to increase her income. By utilizing the mechanical boundaries of separate accounts, the inherent rules of the banking system began doing the heavy lifting of behavioral control. Using the right account for the right job isn't complicated. Sustainable financial growth is achieved simply by matching the timeline of your capital to the mechanical function of the correct bank account.